Securities and Exchange Board of India introduced a new swing pricing framework for debt mutual funds to protect retail investors in times of massive redemptions. But what is it? Swing pricing is a method by which an asset management company adjusts the net asset value of any mutual fund scheme facing redemption pressure by a certain percentage. Once swing pricing is enforced, all investors exiting or entering the scheme can transact only at the adjusted net asset value. This amount is lower than the usual net asset value. The purpose of swing pricing is to pass on the cost of redemptions in the form of a lower net asset value to those selling their scheme units. As per the regulations by the Securities and Exchange Board of India, swing pricing will be implemented only in case of net outflows from a debt mutual fund scheme. Under the framework which will be enforced from March 2022, there will be partial and full swing. In normal times, an asset management company can implement partial swing. In this scheme, the concerned party can introduce an adjusted net asset value for entering or exiting investors once the net outflows from any scheme cross a certain threshold. In extreme market situations, the Securities and Exchange Board of India can declare that markets are dislocated and full swing pricing can be enforced on all high-risk, open-ended debt schemes for a specified period. Why is it important? In April 2020, Franklin Templeton Mutual Funds decided to prematurely wind up 6 of its open-end debt schemes after finding it difficult to meet the concerted redemption demands. This triggered outflows from credit risk schemes of other asset management companies. Since the liquidity in most corporate bonds tend to be erratic in Indian markets, the Securities and Exchange Board of India has decided to adopt swing pricing to avoid such instances. How does swing pricing benefit you? Swing pricing makes debt funds fairer for small investors. In its absence, those exiting a scheme first have an advantage over those who exit later, as they may get the benefit of higher net asset value. Under swing pricing, the money that the fund saves by offering a lower exit net asset value can help shore up value for staying investors. The need for offloading the better quality holdings is reduced. Click the link in the description box below for more details.